David Keller, welcome back to F.A.C.E. People are strange, markets are strange. Welcome back, David. We've been stalking you, and we know you're looking for 4,700 in the S&Ps.
Great singing, Dale. Good morning. How are you?
Great, buddy. How are you?
Good morning, Dave. I just want to say hello before I check out.
Hey, yeah, Blake. How you doing?
Good. Yeah, Dale was just mentioning that I saw a headline in one of your videos. S&P could see 4,700. I mentioned it to Dale like a couple of days ago. He's like, "Well, I have Dave coming in on Thursday." I'm like, "Great. This is exactly the person we want to talk to and see what you're thinking." So, have a great interview, you guys.
All right, thank you, Blake. So, David, you want to share the screen and lay out your case for 4,700 S&Ps?
Yeah. It says I can't do it until someone stops sharing.
Oh, yeah, there.
Oh, there we go. Okay, yeah, perfect. Here we go. Can you see my screen okay?
Yep, got it.
Yeah, so we are in a really, really interesting time, and I feel like you could have said that many times in 2022, but especially now. And the first 6 months of the first 6 months of this year, I mean, when you now looking back, pretty straightforward, right? And you had this consistent stream of data that just seemed to further facilitate the bear case, right? And you could see how with the Fed taking the action they were, the prospect of higher rates, the stronger dollar, which was sort of the wrecking ball for risk assets, kind of everything's going down. But a lot of things have changed from mid-June to mid-August. And, when you think about an upside target in the S&P, you're basically assuming that what's changed is what is going to be the future here for at least the foreseeable future, that you continue to see optimism that the negativity, all the macro negativity, which is still there, and that's the kicker. If the market does rally from here, it's in the face of a lot of macro headwinds. But I think I caught Blake saying, I caught Blake talking about the difference between the stock market and the economy, and a lot of people incorrectly look at economic conditions as a way to try to understand, to project what stocks are doing. And you have to remember, you flip that around, right? The stock market is the best leading indicator of the economy, not the other way around. Yeah. So from a purely technical perspective, we've rallied from 3,650, we'll call it, up to around 4,300 in a pretty short amount of time, in about 2 months. And that rally has created a very different look to the equity markets. The biggest rally in 2022 by far, right? And the March rally was the last one that was the closest, but this one has far eclipsed that. We've gotten to the 200-day moving average, which was unthinkable when we're down at 3,650, but now obviously very accessible. Now, however, we've pulled back, right? So we hit resistance at the 200-day. A lot of individual stocks hit resistance at the 200-day, and stocks like Apple hit resistance at all-time highs, right? So there's a lot of overhead resistance right now. So how do we make sense of things now, right? So I think we're in an interesting environment now where I'm hearing very bullish and very bearish sentiment and perspective from technical analysts that I respect and follow. So it's a very conflicted market. And I got in Blake's comments, I got that. I sensed in his voice sort of a conflicted trader. I could see the bullish argument, but I could see the bearish argument too. And that's what makes it so challenging. So what I like to do in this sort of environment is lay out the guide rails, right? Lay out the levels, the line in the sand at which you accept that the market is different than what you'd expect. So how would I sort of summarize all of this? So number one, we've rallied significantly, but we've not rallied to the point that this really, in my opinion, looks bullish yet, right? Completely, it's so obviously bullish that you just can't be bearish anymore, but we're not far from that level. And I think that's the 61.8% retracement level, which is just about 40 or just below 4370. So the S&P gets to that level. I don't know how you could hold on to being bearish, because I think that really indicates that the market no longer cares about these macro headwinds. We're seeing optimism because of all the things that the Fed is doing. Interest rate hikes are working, and we're going to kind of get through this. If we do get up to 4,700, which would put us pretty much near all-time highs, what I can't imagine is us getting significantly higher than that without a major drawdown. And I think that could be setting us up, thinking of the seasonality, into weakness going into next year. But I'll come back to that in a second. Okay. I think the bear case for the S&P is we're not far from it, right? We sort of had this rally If you look, I mean, one of the things I would take with any of these is, yeah, so I drew it here, right? So just taking the low in June, the high in August, 38.2% of the way down is around 40.60. This shaded area on my chart here in red, which is right around 4,100, I've had on here for quite some time because that was actually the low back in February. That was also right where the rally stalled out in May, right, or just below that. So the market holds this, and this is the beginning of something more meaningful, right? This is the beginning of something more significant. This bull case that I'm talking about, we get below 40.60, and all of a sudden you have to accept that it's more of a retrenchment before a rally. So here's the kicker, though. Seasonally, August into September tends to be pretty tough for stocks. So if the market would just go straight up from here to 4,700, that would be highly unusual given years and years of market history, because September actually tends to be one of the worst months for the S&P, for the NASDAQ, for a lot of individual names as well. So I would say highly unlikely you get this big vertical move in the month of September, which is why I could see us sort of backing and filling for a little bit more before we sort of set the stage for a move higher. And I think setting up for a rally in November and December, which tend to be the seasonally strongest parts of the year, that's how I think you get to that peak. So my base case, as I've sort of talked around it, is I think we back and fill a little bit more here. I think this week in particular with the Powell the comments, I think I heard you mention, Dale, when I was logging on, or one of the other speakers did, about how the market has tended to rally around Fed meetings. That's 100% true, and I would say it's a psychological reason.
That's the last time you and I talked was on the last Fed meeting.
That's exactly right. And there is a 0% chance, in my opinion, that Powell comes out and gives anything but a very constructive picture about how well the Fed is on top of inflation and how it's all manageable and everything's working and QT is no big deal and it's all going to kind of work out. And that optimism is what's fueled these bounces. But what's happened soon after those bounces every other time too is we fizzled out very quickly. And that's how we could bounce back up maybe to the 200-day. But I think we have a little more backing and filling before we could really mount a significant rally. So my base case is sort of chop around here and maybe a bounce going into the weekend. We rotate lower, and I don't know we retest the lows. I think that's pretty aggressive. I think we sort of get down and retrace some of those gains in June, in August into September, which tends to be seasonally weak. That sets us up for a nice run going into year end.
Okay, so into the midterms. I know some people looking for cycle lows at the end of October. What are the standouts that led this rally? Is it the old guard, or is it cyclical in nature? Is there any character change in the sectors that are leading the way this time, or is it the same as it ever was?
No, and I think the best way I would show that is probably talking about interest rates, which you and I have talked about most of the time, I feel like, on the show. I mean, 2022 has been about the dollar and it's been about interest rates. And I feel like equities have been, I was always taught that the bond markets lead the stock markets. And this year has been a great illustration, particularly in the leadership themes, why it's important to look at interest rates. Back at the end of last year, the interest rate environment was going higher, but we still hadn't gotten above the high from earlier in 2021. And that was the big question: was, are we going to go to new highs? Right. And I think that was a while ago. That was like a 1.5 ago in yield terms, in terms of where the 10-year was. From there, we moved higher. And the first 6 months of the year, if you remember, growth completely out of favor. And the second panel down here is the value versus growth ratio, right? So this is going higher. Value stocks are outperforming. First 6 months of the year, it was value over growth. Energy, obviously, a huge outlier to the upside, but other sectors like materials did very, very well, while the FANG sectors struggled. Starting in June, and actually a little before June, you actually start to see that change a little bit. And when the 10-year sort of gets above the 2018 highs, that's actually right when growth starts to reemerge. And so the leadership profile over the last 2 months has been dramatically different, right? And really June and July, where it's technology, communication services doing very, very well. Not as much consumer discretionary on a broader basis, but those other two for sure. And that's a big change. And the reason why they're able to rally, and the reason why the benchmarks, which are very growth heavy benchmarks, the reason why they were able to bounce from the low in June to the 200-day moving average is because of the leadership from those growth-oriented sectors, and that is given space by the interest rates coming down and the dollar lightening up right after being so strong. In August, though, you can see that the ratio is just starting to turn higher. You can see if you look at the last week, most of those days, the energy sector has been number one, and it's not been close, right? It's been energy and then everything else again. So all of a sudden, the sector profile is looking a lot like it did in the first half of the year, as rates are pushing back higher, as the dollar is bouncing higher as well. And so I think the way that we get this sort of choppy, maybe retest kind of feel over the next couple weeks is because rates can move back to the upside a little bit. The dollar sort of, maybe re-exerts itself to the upside, and it would be really tough for the major benchmarks to rally in the face of those headwinds.
I don't know how many times I've tried to pick the dollar top where I get rewarded short term, for a decent move, and then it's in my face again. What's the dollar look like to you? Double top should make a new high here, right?
So from a technical perspective, really, really interesting. I would say, I mean, my sense would be the dollar has further to go to the upside. But from a technical perspective, we are at the very deadly pattern, which is a double topping pattern. It's one of the most classic patterns in technical analysis, which is very simply, we establish a level, we pull back, and then we retest it. And this is the big question mark moment. Do we have enough momentum on the chart to power through that resistance? Now, what's interesting is we had that happen.
But look at that RSI reading. It looks like it peaked in April.
So that is exactly right. We've had this double top pattern a bunch of times so far in 2022, even the second half of 2021, and every one of those times it's powered through it, right? But an uptrend doesn't last forever. And what gives me pause to a raging bullish dollar thesis is this momentum picture, right? Peak in momentum was in April. We made highs a new high really drove there in July on lower momentum. And then again, we're now, testing new highs, and we're not even overbought yet. So a stock or a chart in an uptrend where we make new highs, but it's not overbought is always a bit of a question mark. Now, again, the market can always power through that and then re-exert itself, which is why there should be a big line around 109 on the dollar index. Can it get above there? And I think if and when it does, that should be the signal, to be thinking more on the short side of things like the NASDAQ, because it would be really tough for growth to rally with that happening with the dollar index.
Okay. And the gold miners have a little bit of a heartbeat despite the strength in the dollar. Wondering what it looks like to you.
Yeah, so gold is tough. And I mean, out of all the charts that I review, I mean, we used to talk about things being chart challenged. And I think gold is maybe one of those in 2022. I mean, it's been a tough environment. And the argument for buying gold stocks, and I can bring up like, Newmont, probably the most liquid example. The argument for buying stocks like this is that they've gone down a ton. And I've never found that to be a great justification for owning anything, right? The fact that it's gone down a lot. And I was always taught, never confuse the bottom of the page with support. Just because something's gone down a lot doesn't mean it can't keep going much, much lower. Now, what you get on the chart of like NEM and some of the other gold miners are the same, is you're getting a potential bullish momentum divergence, right? Where it's making new lows in the last week, but on less negative momentum, right? So the price is sloping downwards, momentum sloping upwards. That often can be a contrarian buy signal. What you'd need on something like Newmont Mining is to get above the swing high, right? So you'd have to get above these levels, I think, to sort of validate that signal. Hasn't happened yet. It's bouncing a little bit this week, but I need to see a little bit more.
You picked the worst of breed. I mean, okay. I mean, people call Newmont the best of breed, which it's been for years, but since the years, the earnings about, I don't know how many months ago, when it gapped down, it became, you pull up any other gold mining stock, it doesn't look as weak as Newmont.
Fair point. And the XAU, which we're looking at here, actually put in a higher low in the last week. So granted, right? Yeah, fair point. Yeah. When you think of the group as a whole, though, I still think, how different does this chart look than any other equity you could probably bring up, say for like a median name or something that's just been downtrodden most stocks obviously look way more constructive. And so I think you, just like we talked about with growth stocks that needed to get above their June highs, I think for gold stocks, you need to put in a higher low and then make a new swing high. And that's what we've not seen in any case. I don't think yet. I think the chart of gold.
You think that the market is hated. You look at sentiment readings in gold and the euro, and they're if they could put up a minus sign, they would.
That's exactly right.
Yeah. So again, it's contrarian. Oil,
very much so.
Can you explain why oil shares have been doing so well, even though oil peaked at 130, broke to about 85, 86 bucks, but the oil shares keep charging?
It's amazing, right? There's and usually, I mean, when I was learning about energy stocks, years ago, and was kind of introduced to it, I was told it's an oil call. It's a macro call. Figure out what's happening with oil, and you get what's happening to the oil stocks. And for the most part, over the long term, that tends to absolutely work. I mean, that's been the case. But it's not the case right now. You're actually getting a bit of a disconnect, right? So crude oil, as you mentioned, I think from a technical perspective, clearly still in a downtrend below its 200-day moving average, testing it from below, which is interesting. Yeah. And it's looking similar to kind of what we saw in the fourth quarter of last year, which was a brief dip below the 200-day. And then we started a amount of recovery, and getting back above the 200-day was one of those great signals that this was emerging as one of the great trades of, I mean, even the decade, maybe, right? This rally in energy in the first half of the year. And that really, really showed it. You got to remember, though, that even with the choppiness in oil we saw in the second quarter, energy stocks are still actually doing pretty well.
Yeah.
Right? I mean,
if you got out based on WTI of your oil shareholdings, you missed a lot of upside. So, I mean, if you look at that,
I think, yeah, that's absolutely right. So what's happening to oil, I mean, to energy stocks is, I think, you think about that chart of interest rates, think about the 10-year yield, you think about growth versus value. Value stocks doing incredibly well in the first half of the year. Energy gave back a lot of those gains, but still, one of the few sectors up for the year back in June and July, right? And now again, starting to retrace it. This has done what, gold stocks are kind of down here right now. And you look at what happened with energy, it's sort of, they made a higher low, made a new high, and it's just sort of re-exerting itself to the upside. It's starting to show once again, like it looked in the first half of the year. And again, what this sort of fits into where I feel that the market, the indexes, at least for now, are going to have a lot of difficulty mounting a significant rally. Because if you think the S&P and the NASDAQ's going higher, it's not going to be driven by energy, right? These days when energy was up 3-4%, the averages are flat for the day, right? Or even down a little bit, because it's the growth sectors that really drive the benchmark return. So I could see a scenario where energy stocks continue to do very, very well, even though September is tough for stocks, even if the market as a whole retrenches a little bit and backs and fills and sort of bounces around key support levels. A sector like energy can actually do brilliantly, and I'm seeing a lot to like on that chart here.
Okay, my partner in crime, Stelios, got long uranium ETFs yesterday. I know it's kind of it's even a smaller sector than gold and silver miners, but is it going to get the same type of energy play just out of desperation because of Japan? The charts look pretty good, don't they?
It could be, and to be honest with you, the general commodity space, I mean, to be honest with you, is improving the same way. Now, I mean, something like the DBC is obviously very energy oriented. The challenge with a lot of ETFs that we track, they're very energy heavy, but this is kind of looking at some of the major commodity ETFs. And in general, there's a lot of strength in the commodity space, turning all around. And again, that's very different than what we saw in the beginning of the third quarter. And again, I think that fits into sort of that change of character of the market and how things might be evolving a little bit different than June, July. I think August into September starts to feel a little different.
I know you're a technician, David, but where do you think Powell's going to come down tomorrow at his big speech? And we're sitting here with our mouths wide open, waiting.
Right. So I go back to, as a technician, I look at the evidence, right? And I like to think about what the market does leading into these announcements, how it tends to digest things during the day, and then what happens soon after. And if you look at 2022, it has been optimism going into the Fed, and now really sort of a quiet period, which is pretty natural, right? Kind of have a lighter, sort of sit on our hands and see what happens. But during the press conference and in the hour and a half after 2:30 to 4 p.m. Eastern on every one of those meeting days, you've seen a nice move. And in a lot of times, some days we've reversed very, very quickly, but most of the time we at times had a nice sort of rally soon after. But every one of those times it's gone back lower, right? Because the data that we see, right, on inflation, on jobs and all of that starts to just the general rate environment. It all sort of reminds investors, I think, of the broad headwinds that still remain. Powell's job is to encourage you as investors, as traders, to look past the challenging data that is still kind of going to be there for a little while and think about how what we're doing is going to work just fine.
So you don't think, like a former guest I had, that Powell just wants to help the Democrats in the midterm?
I don't know if I would make that call, but I definitely think he certainly wants to calm the anxiety of the market for sure. One of what's different this time, and obviously this isn't a formal meeting, this is the Jackson Hole conference, but the comments I think are going to be very, very noteworthy. I think the big difference now is we've changed from quantitative easing and how does that unwound, which has now happened, to now quantitative tightening, which is literally the Fed reducing the balance sheet. That has actually not happened a ton, right? We don't have a lot of history to look at, a lot of observations. You can look at when QE has started, you can see when QE has stopped, how the market sort of reacted going in and coming out. And I think we have some good patterns to dig into. Quantitative tightening is very much an unknown. And I think as the market digests that, there could be some fits and starts. It's less of a known thing where the Fed is actually being a little more restrictive than it has been in quite some time. And again, I think if nothing else, I think the VIX has bottomed out at 20. I think we see higher volatility because of higher uncertainty between now and year end.
Okay, we're going to break 38.
Break 38 on the VIX.
On the VIX,
boy, possibly. I don't. That sounds extreme to me. And the range in 2022 has been sort of 20 on the lower end, 35 right at 38 is sort of the upper end. That's why I don't think we get above there. But think about what the market would do if we get from 2022 up to 35. That's how the market sort of backs and fills and sort of hits one of those lower levels down around the 50-day moving average that feel a long ways away, but really are not that far.
Okay, so best way for people to get a hold of you. And Marco, I see your question. Why don't you get a hold of David, someone that wants to talk to you about how you run several analysis on the RSI. So what's the best way for people to reach you? Would it be on Twitter at Keller CMT, through your show, The Final Bar, which is a great show. You're, as good as you are as a guest, you're as good or better as a host. And,
I don't sing for my guests though, Dale, so I'll have to up my game. I'll see what I can do.
I'll send you a DVD. And and anyway, for someone that has questions after this interview, what do you recommend?
Yeah, of course. So social media is great. At Keller CMT is where I'm at on Twitter. I look forward to engaging with people there. My show is on Stock Charts TV. I do the Closing Bell show every day there. So you're welcome to join me. And our previous episodes are at stockchartstv.com.
And you take questions during that show too, don't you?
I do a mailbag twice a week, and we get some really thoughtful questions from people. So you can email me at thefinalbar@stockcharts.com, and I can answer the question on the show.
Well, to wrap it up, if it was my final trip to a bar, I can't think of anyone I'd rather, clink beer glasses with, David. So thank you very much for sharing your outlook and your 4,700 target and the hows and the whys behind it. Really appreciate you coming in over the years and edifying our FA.C.E community, my trading warrior brother.
Always a pleasure, Dale. Be well, stay safe, all right?
Okay, everyone. So that's a wrap. David Keller, everyone. Great technician and a thoughtful guy, cares about his people. Check him out and check out the team in about 18 minutes for the morning edge. Keep your edge, but above that, don't just count your pips, count your blessings. And we'll see everyone to wrap it up before Paul gives us the word tomorrow. You're very welcome, everyone. Thanks again, Dave. Adios.
Hey traders, this is Blake Morrow with ForexAnalytix. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.